Welcome to the deep dive. Today, we're digging into something really interesting. It's right at the crossroads of traditional finance and, well, the crypto world. We're talking about tokenized US Treasuries.
Exactly. Think of them basically as digital versions of U.S. government bonds,
Yeah,
but accessible, right within the crypto ecosystem.
right. A kind of digital wrapper for a very traditional asset. So the core question for this deep dive, and we're using some great analysis here from Cointelegraph Research, plus their statistical models,
Hmm.
is this. Are these tokenized treasuries the key? The thing that finally bridges the gap between, let's face it, the sometimes wild world of crypto and the steadier ground of traditional finance?
It's a big question.
Yeah. So we'll unpack what's driving their growth, look at the projections, and also what could maybe slow things down. Let's start with why they're so popular right now. What's making them appealing?
Well, a huge factor, honestly, is just the sheer growth in crypto adoption itself. Cointelegraph's research points to a pretty significant increase. We're talking 34% more crypto holders globally just since 2023.
Wow, 34%. That's a lot of new people entering the space.
It is. And with more people involved, you naturally get more demand for, well, different kinds of digital assets.
Mhm.
And that includes options that are seen as, less volatile than your typical crypto coin.
Right. It feels like the space is maturing a bit. People aren't only looking for that next, moonshot. They also want places to park value maybe that won't swing wildly overnight.
Precisely. And that's where these tokenized treasuries come in. They offer that digital route to access traditional government bonds. And we're seeing this demand reflected in the market already, big time.
How so?
Cointelegraph notes that the market cap for these products, it's jumped over 150% just this year so far.
150%. Okay, that's definitely a steep curve.
It really is.
And it's not just a gut feeling about growth. Cointelegraph actually crunched the numbers, right, to try and project where this market might land by the end of 2024.
They did, yeah. They used a few different statistical tools, which is interesting. They looked at ARIMA, which is good for predicting based on past trends, and GRCH, which helps model volatility, very relevant in crypto, and also standard linear regression, looking for those relationships between variables.
Got it. So multiple angles. What sort of numbers did these models spit out?
Well, they gave a bit of a range. The ARIMA model was the most, let's say, conservative. It suggested about $2.12 billion market cap.
Okay, the cautious view.
Then the GRCH model, which you might see as the bull case, projected much higher, $3.93 billion.
Big difference.
Yeah. And the linear regression, it landed kind of in the middle at $2.47 billion.
So somewhere between roughly 2 and 4 billion, depending on the model. Did they try to synthesize those, combine them somehow?
They did. They calculated a weighted average based on these models, and that landed them at an expectation of around $2.66 billion by the end of 2024.
$2.66 billion. Okay, that gives us a solid benchmark number to think about.
Definitely.
Now, thinking about who's driving this, it isn't just individual crypto users looking for stability, is it? There's another big player emerging here, DAOs, decentralized autonomous organizations.
Yes, absolutely. DAOs are showing real interest lately. We've seen some concrete examples.
Yeah.
Like Arbitrum. They've indicated they plan to put around $25 million, that's about 1% of their treasury, into these tokenized treasuries.
Okay, 1% for Arbitrum.
And then there's MakerDAO. Their plans are much, much bigger. They're talking about allocating $1 billion, roughly 19% of their treasury.
Wow, okay. $1 billion from MakerDAO, that's a huge statement. What's the motivation? Why are these DAOs suddenly so keen on effectively digital government bonds?
Well, a lot of it seems to be about stability and maybe generating more predictable returns. Think about it. Many DAO treasuries are mostly made up of their own native token.
Right, which can be super volatile.
Exactly.
Yeah.
So by diversifying into real-world assets like tokenized U.S. Treasuries, they're trying to, build a more solid financial foundation, aiming for more long-term stability. It's a de-risking move, in a way.
That makes perfect sense. Like any organization managing a large treasury wanting to reduce risk.
And beyond just stability, they probably see it as a key way to access regulated yield-generating opportunities, tapping into the broader DeFi ecosystem in a safer way.
An on-ramp to yield. Okay. But how do they actually do that? If a DAO holds, say, billions in its own token, it can't just dump it all on the market for treasuries, right? Wouldn't that crash the price?
That's a really critical challenge.
Yes.
Selling huge amounts of their native token quickly could absolutely hurt the price. So they need more strategic ways to do it.
Like what?
Well, maybe things like partnerships directly with the bond issuers, or potentially using their own tokens as collateral for loans to buy the bonds, or perhaps just a gradual acquisition strategy. buying smaller amounts over time to minimize market impact.
Right, spreading it out, less disruption. So if this DAO trend catches on more broadly, what kind of overall impact could that have on the tokenized treasury market?
The potential is pretty significant, actually. If you look at the total value in DAO treasuries, as of late July, it was around $24.3 billion.
Okay, nearly $25 billion across all DAOs.
Yeah. So even if, say, just 1% of that total amount flowed into tokenized US Treasuries across the board,
That would be.
an extra $243 million. Now, what if DAOs, on average, allocated 5%? You're looking at $1.22 billion in new inflows. And a 10% allocation has $2.43 billion.
Those are really substantial numbers, especially when you compare them to the current market size. Cointelegraph mentioned the current market cap is around $1.85 billion.
That's right. So even that 1% scenario, $243 million,
Yeah.
represents a 13% jump from the current market cap.
And the 10% scenario, $2.43 billion, that's more than double the current market size, a 131% increase. Wait, let me recheck that math from the original. The original says a 31% increase for 10%. Let's stick to that for consistency.
Yes, you're right. Let's correct that. The 10% allocation, $2.43 billion, would be a very significant increase relative to the $1.85 billion base. Let's reread the original source's calculation.
Seems my initial quick math was off, and the original's percentage might also need context check, or perhaps it was based on an earlier baseline. Let's reevaluate based on the numbers provided. $2.43 billion inflow on a $1.85 billion base is indeed more than doubling it, closer to a 131% increase. The 31% mentioned in the original might have been a typo or based on different figures. Let's proceed acknowledging the potential for substantial growth, maybe just emphasizing the dollar figures rather than percentages if there's ambiguity.
Okay, good catch. Let's focus on the scale then. Adding potentially $1 or even $2 billion from DAOs alone would absolutely move the needle in a significant way for this market.
Absolutely. It really underscores how influential DAOs could become in this specific space. But, it's not necessarily all smooth sailing ahead. There's a potential headwind we need to factor in.
Okay, what's that?
The expected interest rate cuts from the U.S. Federal Reserve. Ah, right. The macro picture. Always important. What are the expectations there? Timing. Size of cuts.
Well, the analysis suggests the Fed will likely start cutting rates, maybe around September,
Mm-hmm.
and could potentially bring the target range down to maybe 4.25% to 4.5% by December.
Okay, down from the current 5.25% to 5.5% range. That's a noticeable drop.
It is.
So how does a lower interest rate environment affect U.S. Treasuries and, by extension, these tokenized versions?
Well, fundamentally, lower interest rates generally mean lower yields on newly issued treasuries. And if inflation stays somewhat sticky, which is a possibility,
Right.
then the real return, adjusted for inflation on these treasuries might look less attractive to investors.
Okay, so the core appeal of the underlying asset might diminish somewhat.
Exactly, which raises the question, could this make tokenized U.S. treasuries less appealing overall? Could it slow down that growth trajectory we've been talking about, even with all the potential DAO money coming in?
It's a really interesting tension, isn't it? You've got this pull from within the crypto world, growing adoption, demand for stability, DAOs diversifying, pushing growth, but then you have this potential pushback from the traditional finance side, the macro environment, with rate cuts possibly making the underlying asset less attractive.
Precisely. It sets up a really dynamic situation to watch for the rest of this year.
Okay, so let's try and wrap this up. Key takeaways. We've seen really significant growth in tokenized U.S. Treasuries. It seems driven by wider crypto adoption and this real need for stable, maybe yield-generating digital assets. The projections from Cointelegraph's models, while varied, generally point towards continued growth in 2024, potentially pushing the market cap well past the $2 billion mark, maybe even towards $2.66 billion on a combined basis.
Yeah, the outlook based on those models is pretty positive.
And then there's the DAO factor, huge potential inflows there, maybe adding billions, depending on how widely they adopt the strategy.
A major potential catalyst, for sure.
But we have to keep an eye on the Fed. Those expected interest rate cuts could dampen the appeal of treasuries overall, acting as a bit of a brake.
It's the key counterpoint, yeah.
Yeah.
The macro environment matters.
So ultimately what we're seeing here is this fascinating convergence, this meeting point between TradFi and crypto. Tokenized treasuries really sit right in the middle of that.
They really do. They embody both the exciting opportunities and, frankly, the complexities that come with blending these two worlds.
Absolutely. It really gets you thinking, with this changing macro landscape and DAOs getting more sophisticated financially. what other traditional assets might be next? What else could get tokenized? And what would that mean for the future of finance? Something to chew on. Thanks for taking this deep dive with us today.